Welcome to the debate.
If you open up an old school mechanical cash register, the gears and levers inside, they're perfectly predictable.
Right, completely deterministic.
Exactly. You press a 5, then a 0, you hit the plus sign, and you know exactly what the physical machine will do. It's a closed system. It follows the rules of mathematics without hesitation, without anxiety, and it certainly doesn't have any lingering regret about whether it should have saved that $50 for a rainy day.
No, the machine is blissfully binary. It fundamentally does not care if that $50 was earned through, a grueling 12-hour shift in the blazing sun, or if it was just found fluttering on the sidewalk by pure chance.
Yeah, it doesn't care at all.
Right, to the physical gears of the machine, $50 is exactly $50. It has a completely static, unyielding value.
Yet the moment you step out from behind that counter and actually look at the human beings making the purchasing decisions, well, that perfect mathematical predictability just seems to completely shatter. So today we're exploring a really foundational economic issue.
The true nature of human decision-making.
Precisely, how we fundamentally value our money and our resources. We are analyzing the deep tension between the traditional neoclassical model of economic rationality and the emerging psychologically driven framework of behavioral economics.
Yeah, and the central question we really have to wrestle with today is whether humans actually act as rational utility maximizers, where, their seemingly illogical financial decisions are just temporary anomalies in a broader system, or
if they're predictably irrational.
Exactly. If human decision-making is predictably driven by complex emotional states that honestly require us to completely tear down and rebuild how our economic models are constructed.
Well, I represent the traditional economic view here, and I argue that the traditional neoclassical model, which operates on the assumption that people take all available information to make consistent decisions in their own best interest. I argue that it remains by far the most robust, powerful framework for understanding how markets function.
Even with all the messy human emotion?
Even with it. Because a core, non-negotiable tenet of this position is the concept that dollars are fungible, meaning currency has equal value to the individual regardless of the situation, the origin of the money, or the emotional state of the spender.
Well, I approach this from the behavioral economics perspective, and I'd argue that those traditional models omit a totally critical, undeniable variable, which is the human state of mind.
Okay, but how does that?
By integrating psychology into our economic frameworks, we can definitively prove that these so-called irrational behaviors, they aren't random, messy quirks at all. They are systematic, they're hardwired, and they are entirely predictable responses to emotional framing.
All right, well, let's jump right into the bedrock of the traditional model, which is this idea of fungibility.
Sure.
In standard macroeconomic theory, we consider every dollar to be mathematically and practically indistinguishable from another dollar. Your purchasing power, right, your economic utility, is dictated entirely by the total aggregate amount of resources you possess. If you have $100, it really does not matter if it's in your left pocket, your right pocket, your checking account, or, stuffed under your mattress. It operates exactly the same way in the broader economy.
And that premise right there is exactly where the traditional model encounters its first catastrophic failure in the real world.
Catastrophic seems a bit strong.
I don't think it is. Mainstream economists build their entire worldview, their entire predictive architecture on that assumption of strict fungibility. But when you observe actual human behavior, people do not aggregate their wealth like that.
They don't?
No, they use a well-documented psychological mechanism called mental accounting. They compartmentalize. They put dollars into different mental buckets, and once inside those subjective buckets, those dollars literally take on different values and rules for how they can be spent.
Well, I would challenge the use of the word value there. They might take on different uses based on temporary preferences, sure, but the fundamental underlying value of the currency remains completely static. The market still prices goods based on the assumption that a dollar is a dollar.
But the behavioral outcome proves that the internal valuation changes dramatically. Let's look at a specific scenario from the source material to illustrate this mechanism.
Okay, lay it out.
Imagine a person walking down the street and they spot $25 just lying there on the pavement.
A lucky day.
Right. Most people treat that found money as what behavioral economists call mad money. They'll spend it frivolously. They'll buy a fancy lunch they normally wouldn't purchase or some gadget they don't actually need.
Sure.
They spend it with almost zero rational regard for maximizing their utility or finding the best value.
Well, that's just the classic easy come, easy go mentality, right? The psychological cost of acquiring the asset was zero, so the threshold for dispensing with it is correspondingly low.
Exactly the point. The friction is gone. But now, take that exact same $25. But this time, imagine the person earned it by working 3 hours of a grueling, grease-covered shift at a fast food restaurant.
Okay.
They treat that money entirely differently. They guard it fiercely. They mentally earmark it for essential survival, rent, groceries, the electric bill.
Right, because of the effort involved.
Yes, because the context of its acquisition fundamentally alters the value of the money in the person's mind. Your traditional, rational economizer model completely fails to predict their behavior here.
I wouldn't say it fails.
The mathematical input is absolutely identical in both scenarios. It's a net positive change of $25 in total wealth. But the human output, the actual economic decision, is totally divergent.
Well, that's an interesting point, though. I would frame it differently.
How so?
You are looking at an isolated, momentary psychological reaction to finding money on a sidewalk, and you're using it to challenge an entire macroeconomic framework. We have to remember what an economic theory actually is, fundamentally.
It's a model.
Right. It's a simplified representation of reality. Its entire purpose is to take complex, chaotic, deeply messy real-world interactions and simplify them down to their absolute core essentials so we can make broad predictions.
But if the prediction is wrong,
I think about the source material. It draws a brilliant comparison to a carpenter's toolkit. When a carpenter goes to build a house, they don't need a tool that perfectly mimics the microscopic molecular structure of the pine wood they're cutting. That would be useless. They just need a saw that cuts a straight line.
Yeah. But if you are building a house on an active earthquake fault, a perfectly straight, rigid saw is not going to save you if you completely ignore the ground shaking beneath your foundation.
I don't think human emotion is an earthquake that destroys the house, though.
It is. Traditional economics builds a mathematically perfect house, but it assumes a stable foundation of perfect rationality. Behavioral economics acknowledges the earthquake of human emotion. If your tools don't account for the environment, the house collapses.
But the foundation isn't collapsing. It's actually remarkably stable in the aggregate. By treating dollars as fungible, traditional economics prescribes how economic actors should behave to maximize their utility. But more importantly, it effectively predicts how markets behave at scale.
At scale, maybe? But
yes, an individual person might act like a messy outlier on a Tuesday afternoon and blow $25 of street money on a whim. But when we zoom out to the macro level, when we look at millions of transactions, consumer demand across entire populations, the global flow of financial capital, the aggregate predictive power of the traditional model holds incredibly firm.
you think it just washes out?
I do. The idiosyncrasies cancel each other out.
If we had to build a mathematical model that accounted for the emotional origin of every single dollar in the global economy, the model would be so hopelessly complex it would yield zero usable insights.
I hear the argument for mathematical elegance, I really do. But ignoring a massive behavioral variable, just because it makes the spreadsheet harder to balance, does not mean the variable isn't driving the economy.
But it's not driving the economy, it's just...
The idiosyncrasies do not cancel each other out because human beings are not randomly irrational. We are systematically irrational in the exact same direction. Let's push this further into how people evaluate gains and losses. Because this is where the traditional model's assumption of aggregate neutrality really falls apart under scrutiny.
Well, I am glad you brought up aggregate neutrality because honestly, it is one of the most logically sound premises we have.
Really?
Absolutely. In traditional economics, we rely on a very clean premise regarding total wealth states. A gain and a loss of equal mathematical amounts cancel each other out perfectly.
Okay, let's test that.
Let's say you lose a $10 bill on your commute to work this morning. But then your boss hands you an unexpected extra $10 in your paycheck that afternoon.
Right.
You are in the exact same financial position you were in when you woke up. It's a $0 net change in your total wealth state. -10 plus +10 equals 0. Therefore, according to the standard model, a perfectly rational actor should feel perfectly neutral and their future spending behavior should remain unchanged.
I'm sorry, but I just go by that. Let me tell you why. That perfectly neutral actor you just described, they do not exist anywhere outside of a university textbook.
Oh, come on.
It's true. When you actually study real human beings facing that exact scenario, they do not feel neutral. Not even close. They feel angry, frustrated, and cognitively distressed by the loss of that initial $10.
Sure, momentarily.
And crucially, the subsequent $10 gain does not neurologically wipe out that negative emotion. We humans tend to focus vastly more on the sting of a loss than the thrill of a gain.
Ah, so we are delving into loss aversion here.
We are. This was documented in a landmark 1979 article in Econometrica by the pioneering psychologists Daniel Kahneman and Amos Tversky. They developed what they called prospect theory.
Right, very famous work.
They proved empirically that a $1 loss pains humans roughly 2.25 times more than a $1 gain helps us. We feel the agony of losing more than double the joy of winning.
And you're saying that breaks the model.
It shatters it. And there is a profound evolutionary mechanism behind this. Imagine our ancient ancestors on the savannah. If you happen to miss an opportunity to gain an extra day's worth of calories, you might be a little hungry, but you survive. But if you ignore a threat that causes you to lose your existing food supply, you die. We are biologically hardwired to over-index on losses. This fundamentally shatters the traditional idea that the human mind is an unemotional, objective cost-benefit adding machine.
Well, the evolutionary biology argument is compelling, I'll give you that. But how does that dismantle the macroeconomic model of modern financial markets?
Because this inherent 2.25 times focus on loss dictates major trillion-dollar real-world economic actions. Think about how people overplay their hands in the stock market.
Okay, let's talk about the stock market.
Because of loss aversion, retail investors, and honestly even institutional fund managers, react far more violently to short-term losses than to equivalent gains. They panic sell during a minor market dip simply to stop the psychological pain of watching a red arrow go down.
Or they hold on too long.
Exactly. They hold on to a fundamentally doomed, losing stock way too long just to avoid actualizing the loss on paper. You simply cannot accurately model financial market volatility without factoring in this asymmetric psychological reality.
I absolutely acknowledge the empirical reality of Kahneman and Tversky's findings regarding human emotion. It's fascinating, Nobel Prize-winning research for a reason.
Right.
But feeling psychological frustration over a dropping stock portfolio does not negate the fundamental laws of supply, demand, and market efficiency. What you are describing as a rational panic in the stock market often has a perfectly rational underlying mechanism if we just consider the concept of information asymmetry.
Information asymmetry? Wait, you're suggesting that retail investors who panic sell at the bottom of a market dip are just efficiently processing data?
In many cases, yes, that is exactly what they are doing. Let me explain the mechanism here. In a market system, prices serve as a highly efficient mechanism for disseminating information. Think of a dropping stock price like a fire alarm in a crowded theater.
Okay.
You don't need to personally see the flames or know the exact chemical composition of the fire to know you should rapidly exit the building. When an investor sees a sudden sharp drop in an asset's price, that drop is a signal. It signals a fundamental weakness in the firm or the broader economy that the investor wasn't previously aware of.
But they're reacting to the price action, not the underlying fundamentals.
Because the price action is the proxy for the fundamentals. Their swift exit might look like pure emotional loss aversion to a behavioral economist observing them in a sterile lab experiment.
Right. But
But in the wild, it is often a highly rational response to imperfect information. They are rapidly updating their risk assessment on the fly. They see the price plummet. They rationally assume that other, perhaps institutional market participants, know something they don't, and they rationally decide to cut their exposure. The market aggregates all this disparate information into the price.
I hear you, but if it were purely a rational informational update, as you suggest, the market's reaction to positive news and negative news of equal magnitude would be symmetrical.
Not necessarily.
It would have to be. But anyone who watches the markets knows it isn't. The reaction is deeply asymmetrical. Markets take the stairs up and the elevator down.
Well, panic moves faster than optimism.
Inherently biased toward avoiding pain. The market price system might be an efficient messenger, but the human beings receiving the message are wearing highly distorted psychological glasses.
I wouldn't call them distorted.
They do not evaluate outcomes based on their total wealth state. They evaluate outcomes relative to a reference point, usually the exact price they bought the stock at. If the price is below their reference point, they're in the domain of losses, and their risk-taking behavior becomes wildly erratic.
But again, we return to the aggregate. Even if the individual's internal cognitive process is fraught with reference point dependence and emotional distress, the market aggregates those millions of decisions efficiently. The price still clears, sellers find buyers, the system functions.
All right, let me bring the listener directly into this because I want to give you the ultimate example from the source material that proves traditional models fundamentally fail to account for real-world consumer choices.
Bring it on.
If anyone listening right now has a couple $1,000s sitting in a low-yield savings account, but simultaneously carries a balance on their credit card from month to month, you are living proof that the traditional economic model is incomplete.
The paradox of simultaneous debt and savings.
Yes, this is the absolute peak of irrational mental accounting.
Well, walk us through the mechanics of that paradox. Let's hear it.
Consider a person carrying exactly $1,000 in credit card debt. Let's say that debt has a 15% yearly interest rate.
Pretty standard.
Right. That means it's costing them $150 annually just to service that debt. Now, simultaneously, this exact same person holds a $2,000 savings account paying a standard 2% interest rate.
Okay.
That savings account is earning them $40 annually. So they're paying $150 to the credit card company while collecting only $40 from the bank. By holding both accounts, they are actively, mathematically, choosing to lose $110 a year.
It is a very common, mathematically suboptimal capital allocation. I agree.
Suboptimal is a polite word for irrational. The strictly rational step, the absolute only step your traditional utility maximizing model would predict, is for this person to immediately take $1,000 from their savings, wipe out the credit card debt completely, and net $20 a year on their remaining $1,000 in savings. Yet a massive percentage of consumers flatly refuse to do this. They stubbornly treat the dollars as non-fungible. They build a psychological fence between the two accounts.
And why do you argue they build that fence?
Because of the cognitive strain of facing debt versus the cognitive ease of seeing savings. Paying off the debt means acknowledging a past financial mistake.
It hurts to look at it.
Exactly. It forces you to look at the negative balance, which triggers that 2.25x loss aversion pain we discussed earlier. On the flip side, looking at a $2,000 savings balance provides an immediate neurochemical reward. It feels like safety.
Right, it's a comfort thing.
So people irrationally prioritize the psychological dopamine hit of the savings account over the mathematical reality of bleeding money to credit card interest. They compartmentalize the decision entirely.
Well, I'm not convinced by that line of reasoning because it assumes a rigidly narrow, purely mathematical definition of what utility actually is.
How so?
You're arguing the traditional model is broken because the consumer isn't maximizing their exact dollar count on a sterile spreadsheet. But I would challenge you by proposing that this behavior is actually deeply, profoundly rational, provided we correctly understand how this specific individual calculates their own personal utility in a world of uncertainty.
Wait, how on earth can knowingly losing $110 a year in negative interest arbitrage be considered a rational optimization of utility?
Because utility is not just about maximizing dollars and cents. It's about maximizing total well-being. Think about the volatile economic environment this consumer actually lives in.
Okay, they have stress.
Or they've experienced a sudden, devastating, unexpected expense in the past, a medical emergency, a blown transmission on their only vehicle.
Sure, life happens.
Right. And if their car breaks down, they cannot pay a mechanic with available credit on a Visa card if that mechanic only takes cash. They cannot pay a landlord with a paid-off credit card if the bank suddenly decides to lower their credit limit during a recession.
So you're reframing the mathematical loss as a purchase?
Precisely. The psychological comfort of having $2,000 in hard, liquid cash, money they can access instantly without asking a bank for permission, without a credit check, without worrying about an algorithm freezing their account, that provides a massive amount of personal utility.
That's quite a spin.
It's not spin. That peace of mind, that tangible insurance against the unknown is an intangible good. They are essentially purchasing that insurance policy for the cost of $110 a year in net interest. When you view it through the lens of purchasing liquidity and optionality, the traditional model isn't broken at all. The consumer is simply making a rational trade-off. Behavioral economists aren't disproving rationality. They're just revealing that human utility equations factor in the heavy price of uncertainty.
I mean, I see the conceptual elegance in that argument, but honestly, it feels like a post hoc rationalization designed to save a failing theory.
I disagree.
You're stretching the definition of utility so wide that literally any human behavior can be categorized as rational after the fact. If a person sets their life savings on fire because it makes them feel warm for 3 minutes, you could theoretically argue they are rationally maximizing their utility for heat.
Well, that's absurd.
But it follows the same logic. The core problem with the traditional defense is that it assumes people deliberately, consciously calculate this trade-off. You are assuming the consumer sits down, looks at the numbers, and says, yes, I have weighed the variables and I will happily pay $110 for the insurance of liquidity. But decades of behavioral research show they do no such thing.
They don't have to calculate it on a piece of scratch paper for their revealed preference to be true.
But the decision isn't an integrated calculation of risk. It's a cognitive blind spot. The mental account for savings is guarded by that psychological fence, and the mental account for debt is ignored because looking at it causes stress.
But the result is the same.
It is not a calculated purchase of liquidity. It's a failure to treat money as fungible. If you ask them directly if they wanted to pay a bank $100 a year for no reason, they would say no. But the framing of the accounts tricks their brain.
Look, I understand that the cognitive process might not be a literal cost-benefit analysis happening overtly in their prefrontal cortex. But economics, at its core, is the study of how human beings make decisions in the face of scarcity.
Right.
Even if the individual isn't doing the overt math, their actions reveal a deep-seated preference. Their actions reveal that in a world of scarcity and danger, they value cash on hand over debt reduction. Our traditional macroeconomic models function remarkably well precisely because they track these revealed preferences in the aggregate. We track what people actually do regardless of the messy internal monologue driving the action.
But if we know for a fact that the internal monologue is systematically biased, if we know scientifically that people reliably experience 2.25 times more pain from a loss than joy from a gain, and that they irrationally compartmentalize their money based on how they acquired it, why wouldn't we build those parameters into the model?
Because it dilutes the predictive power.
Why stubbornly stick to the myth of the perfectly rational, neutral actor when we have the tools to model the reality of human behavior?
Well, as we begin to wrap up our discussion, I think that question perfectly frames where we stand. From my perspective, the traditional model of rationality, utility maximization, and fungibility remains the absolute most powerful baseline tool we possess for both macroeconomic and microeconomic analysis.
A baseline, sure.
Yes, individual human beings are endlessly complex, and they sometimes act like messy outliers who don't perfectly fit the elegant equations. But as a framework for understanding how global markets clear, how prices instantly disseminate vital information, and how capital flows across borders, the foundational assumption that people generally act in their own best interest to maximize their well-being is indispensable. It's the saw that cuts straight.
And I maintain that because humans so consistently evaluate outcomes relative to subjective reference points, viewing gains and losses as deeply emotional events rather than absolute mathematical values, We simply can't afford to treat these behaviors as mere anomalies. Or, acceptable margins of error.
Right.
Loss aversion, mental accounting, cognitive framing, these are deeply ingrained in the human operating system. Therefore, incorporating these psychological realities is not an optional academic exercise. It's completely essential for creating an accurate economic framework that actually reflects how human beings live, work, and trade in the real world.
Well, despite our fundamental disagreement on the underlying architecture of these economic models, I think we find a great deal of common ground in our shared curiosity. Looking deeply at the mechanics of why people make the choices they do provides immense, undeniable value to the field.
Absolutely. What mainstream economists traditionally dismissed for decades as quirky or irrational behavior, the noise in the data, actually has profound underlying structural reasons rooted in our evolutionary history.
Yeah, it's not just random.
No! There is a deep, identifiable logic to human emotion, and it merits the most rigorous, respectful study we can give it. Integrating psychology into the equation does not destroy the discipline of economics, it enriches it. It makes it human. There is clearly so much more nuance to explore in this material.
I couldn't agree more. Economics ultimately does not dictate the definitive answers to the staggering complexities of human life, but it can illuminate our choices. It gives us a structured lens to understand how we navigate a world defined by scarcity and uncertainty.
Well said.
Which brings us right back to that mechanical cash register we talked about at the beginning of the hour. The physical gears inside the machine are perfect, predictable, and flawlessly rational. But the hands that operate the machine and the incredibly complex minds that decide what to buy are wonderfully, infuriatingly human. We leave it to you, our listeners, to weigh the evidence and form your own conclusion about the true nature of economic rationality. Thank you for joining us.